super important for the bar exam. For usual and customary matters, think routine, day-to-day operational stuff like ordering standard supplies or paying a recurring bill, a partner can generally act individually.
But with a caveat, right?
Yes, the caveat is they shouldn't act alone if they know other partners might disagree or if it's something that obviously warrants consultation. It's about reasonable judgment even in routine matters.
Okay. What's the next level up?
Ordinary partnership decisions. These are more significant than routine tasks, but still within the normal course of business. Examples: hiring a non-executive employee, approving a minor advertising campaign, setting store hours. These generally require approval by a majority of the partners. So if there are 3 partners, you need 2 to agree.
Right. Majority rules for ordinary business. What about the big stuff?
For matters outside the ordinary course of business, the threshold jumps significantly. This requires the consent of all partners, unanimous approval.
And what falls into that category?
Think major strategic shifts. Selling off a core asset of the business, like the main factory. Changing the fundamental nature of the business. A bakery deciding to become a tech startup. Taking on a massive loan that wasn't budgeted. Merging with another company. These fundamentally alter the partnership or its risk profile.
Okay, unanimous for big, non-ordinary decisions. What else requires everyone to agree?
2 other key ones mentioned in our source. Amending the partnership agreement itself requires all partners. You can't change the foundational rules without everyone's consent. And admitting a new partner also requires all partners. You can't force someone to accept a new co-owner they didn't agree to. It changes the fundamental relationship.
That tiered approval system makes a lot of sense. It balances efficiency for routine stuff with collective control over major decisions.
Exactly. It prevents one partner from going rogue on huge issues while still allowing the business to function day to day. Knowing which level of approval is needed for which action is absolutely critical, both for running a partnership smoothly and for answering exam questions correctly.
Okay, partnerships change. People leave. And this is where terminology gets really, really important, especially for the bar. We need to nail the difference between dissociation and dissolution.
Absolutely crucial distinction. They sound similar, but mean very different things. Dissociation is when an individual partner leaves the partnership. Think disassociate, no longer associated. Dissolution, on the other hand, is the start of the end for the partnership entity itself. It's the beginning of the termination process.
So a partner dissociates, but the partnership dissolves.
Yeah.
Got it. What triggers dissociation? How does a partner actually leave?
Our UPA lists several triggering events. The most obvious is the partner giving notice of withdrawal. They voluntarily say, "I'm out." Others include the partner's expulsion, maybe based on the agreement, a unanimous vote of other partners for specific reasons, or the partner going bankrupt. Also, the partner's death, the appointment of a guardian due to incapacity, a court ruling that the partner is incapable of performing their duties, or if the partner is an entity like a corporation, that entity's termination. Any of these separates the partner from the ongoing business.
Okay, can a partner always leave whenever they want? Or can leaving be considered wrongful?
A partner generally has the power to dissociate at any time. You can't force someone to remain a partner against their will. But they may not always have the right to dissociate without consequences. Dissociation can be wrongful, and if it is, that partner can be liable to the partnership and the other partners for any damages caused by their wrongful departure.
So you can leave, but it might cost you if you do it improperly. How is wrongful defined? Does it depend on the type of partnership?
Yes, it absolutely depends. Our source breaks it down. For a partnership with an unlimited term or undertaking, an at-will partnership with no set end date, dissociation is wrongful mainly if it breaches an express provision in the partnership agreement. For example, the agreement says partners must give 6 months' notice and someone leaves tomorrow. That's wrongful. And importantly, in an at-will partnership, any dissociation that occurs because a partner simply chooses to withdraw, expresses their will to leave, typically triggers dissolution of the entire partnership.
Okay. What about partnerships for a specific term or project?
For a partnership with a definite term or undertaking, dissociation is wrongful if before that term ends or the project is done, the partner just withdraws or is expelled by a court or becomes bankrupt, or if an entity partner willfully dissolves. Now, the consequence here is different. This wrongful dissociation doesn't automatically cause dissolution. It only triggers dissolution if, within 90 days, a majority of the remaining partners agree to wind up the business.
So in a term partnership, the remaining partners have a choice whether to continue or dissolve after a wrongful dissociation.
Generally, yes, if a majority wants to dissolve. If not, the partnership could potentially continue without the wrongfully dissociated partner who would still be liable for damages.
Okay, so dissociation happens. What are the immediate consequences for the partner who left and the partnership?
The dissociated partner immediately loses the right to participate in management. Their active role ends. Generally, their fiduciary duties also end, except for duties related to things that happened before they left, or if they participate in winding up if the partnership dissolves. The partnership, if it continues, must buy out the dissociated partner's interest, pay them the value of their stake. And it must indemnify the dissociated partner against partnership liabilities, both pre- and post-dissociation liabilities, basically taking responsibility for them.
So the partner gets paid out and gets some protection from future debts. What about debts incurred before they left? Are they still liable for those?
Yes, a dissociated partner generally remains liable for partnership obligations that were incurred before their dissociation. Leaving doesn't erase past debts.
Oh, okay. Now, this sounds tricky.
Yeah.
Can a partner who already left still somehow bind the partnership to new deals?
Yes, the lingering apparent authority problem. This is that 2-year rule you often see tested. For up to 2 years after dissociation, a dissociated partner can still bind the partnership and themselves to a transaction of the third party they're dealing with. 1, reasonably believes the dissociated person is still a partner. 2, doesn't have actual notice or knowledge of the dissociation. And 3, isn't deemed to have knowledge, like through a public filing, which we'll get to.
Whoa. So someone could leave and then a year later sign a contract with an old supplier who didn't know they left, and the partnership could be stuck with it.
Potentially, yes. Let's use your coffee example. Alex dissociates from Global Coffee Roasters. 6 months later, Alex calls their longtime bean supplier, who always dealt with Alex and doesn't know he left, and orders a massive amount of expensive beans. If the supplier reasonably believed Alex still had authority and had no notice, Global Coffee Roasters might be bound to pay for those beans, even though Alex had no actual authority. Alex could also be personally liable.
Okay, that underscores the massive importance of giving notice to third parties when a partner leaves. You need to tell suppliers, banks, customers.
Absolutely critical. Filing a statement of dissociation with the state can also help provide that notice after 90 days, but direct notice is fastest and safest for known contacts. It cuts off that lingering apparent authority. Fundamentally, these dissociation rules are trying to balance the partner's freedom to leave with protecting the ongoing business and ensuring fairness to third parties who might not know about the internal change immediately.
Okay, that 2-year rule really highlights how partners' actions affect outsiders. Let's circle back to that idea of partners as agents and how they bind the partnership to third parties. You mentioned actual and apparent authority.
Right. A partner binds the partnership if they act with either type of authority. Actual authority is the authority the partnership intends the partner to have. It can be express actual authority explicitly granted in the partnership agreement or by a vote of the partners for a specific deal. Very clear. Or it can be implied actual authority that's reasonably necessary or customary to carry out the express authority. If you're expressly authorized to manage the store, you have implied authority to, say, order, inventory, or schedule staff.
Okay, so actual authority comes from inside the partnership's decisions. What about apparent authority again?
Apparent authority is about what the third party reasonably believes based on the partnership's actions or the partner's position. It arises when a partner takes an action that seems typical for the partnership's business, something in the ordinary course, even if they weren't actually authorized internally to do that specific thing.
So if a partner looks like they have authority to a reasonable outsider, the partnership might be bound, even if they secretly told that partner, don't sign contracts over $500.
Exactly. If that partner regularly signs $1,000 contracts in the ordinary course of business, and the third party doesn't know about the secret $500 limit, the partnership is likely bound by the $1,000 contract due to apparent authority.
Is there an exception?
Yes. The crucial exception is if the third party knew or had noticed that the partner lacked actual authority. You can't knowingly rely on authority you know doesn't exist.
Makes sense. What about non-contract liability, like torts? If a partner messes up and hurts someone.
The partnership is generally liable for a partner's tortious acts, negligence, fraud, etc., if those acts were committed in the ordinary course of the partnership business, or if they were committed with actual or apparent authority from the partnership.
So if a partner is negligently driving the partnership delivery van and causes an accident, the partnership itself can be sued.
Correct. The partnership entity is liable. Its assets are on the line.
Okay, now the big one again. Partner liability to third parties. We know it's personal liability for general partners, but let's refine that.
Right. Partners are jointly and severally liable for all partnership obligations.
Breakdown jointly and severally. What does that mean practically?
It means a creditor owed money by the partnership can pursue any one partner for the entire amount of the debt, regardless of that partner's individual ownership percentage. So, if the partnership owes $100,000, the creditor could sue partner A for the full $100, even if partner A only owns 10% of the partnership. If partner A pays, it's then up to partner A to try and recover the proportionate shares from partners B and C.
Wow. So the creditor doesn't have to chase everyone down proportionally. They can go after whoever seems easiest to collect from.
Pretty much. That's the power of joint and several liability. Now, a key point from the source. This generally applies to obligations arising after a partner joins. An incoming partner is usually not personally liable for debts the partnership already had before they became a partner. Their liability starts when they join.
Okay, that's a small bit of relief for new partners.
Hmm.
And how does collecting a judgment work if a creditor wins a lawsuit against the partnership?
There's an important order of operations for judgment satisfaction. Getting a judgment against the partnership entity doesn't automatically mean the creditor can immediately seize the partner's personal assets. The creditor generally must first try to satisfy the judgment from the partnership's assets. They have to exhaust the partnership's resources.
So drain the business account first.
Essentially, yes. Only if the partnership assets are insufficient can the creditor typically go after the personal assets of the partners who are jointly and severally liable. Even if the judgment names both the partnership and an individual partner, the rule is usually partnership assets first, then partner's personal assets.
Why is that rule important, that partnership first rule?
It provides a crucial layer of protection for the partner's personal wealth. It ensures the business itself bears the primary responsibility for its debts. It also clarifies the collection process. For creditors, they know where to look first. It respects the entity's status to some degree, while still preserving the ultimate personal backstop.
Okay, partnerships aren't always static. They can change their legal form, right?
Correct. RUPA provides mechanisms for partnerships to evolve. Two key ones are conversion and merger.
What's conversion?
Conversion is when a partnership changes its type of legal entity. For example, a general partnership might convert into a limited partnership, LP, or an LP might convert into a general partnership, or even convert into an LLC or corporation, depending on state law. It usually requires approval by all partners because it's a fundamental change in structure and liability, and you have to file official articles of conversion with the state to make it legally effective.
Does conversion affect past liabilities? Like, if an LP with limited partners converts to a general partnership where everyone has personal liability?
Good question. The source notes a key protection.
All
If
right.
an LP converts to a general partnership, the former limited partners continue to have limited liability for obligations that arose before the conversion. They don't suddenly become liable for old debts just because the form changed.
Okay, that's important protection.
Yeah.
What about merger?
Merger is when two or more separate business entities combine into one single surviving entity. So Partnership A and Partnership B could merge, with A surviving and B disappearing, or they could merge into a completely new entity, C. This requires the partners of the merging entities to approve a detailed plan of merger, outlining all the terms, how assets and liabilities are transferred, what happens to partnership interests, the name of the survivor, etc. It's a way to combine businesses formally.
All right, let's talk about the end game. How does a partnership actually terminate? We touched on this, but let's formalize it. It's that two-step process: dissolution first, then winding up.
Right. Dissolution is the trigger event, the start of the end. Winding up is the process of closing shop. Exactly. Dissolution means the partnership stops carrying on business as usual, except for activities needed to wind up. Winding up is the actual liquidation and settlement process. Now, the specific events causing dissolution depend heavily on the type of partnership. For a partnership at will, no fixed term, dissolution is triggered by several things, including a partner simply giving notice of withdrawal. One partner says, "I'm out," and boom, dissolution begins. Also, an event specified in the agreement, something making the business illegal, or a court order.
So at-will partnerships are pretty fragile in that sense. One partner leaving can dissolve the whole thing.
By default, yes, which is another reason specific agreements are common. Now, for a partnership for a term or undertaking, dissolution happens when the term expires or the undertaking is completed, or if all partners agree to dissolve early, or, importantly, if a partner dissociates due to death, bankruptcy, etc., Dissolution occurs only if, within 90 days, at least half of the remaining partners vote to dissolve.
So again, more stability in a term partnership. Dissociation doesn't automatically kill it.
Correct. Now, once dissolution is triggered, what happens in the winding up process? The dissolved partnership continues, but only for the purpose of winding up its affairs, selling assets, paying debts, distributing any surplus. Though interestingly, partners can unanimously agree to stop winding up and resume business if it's not too late.
Who actually does the winding up?
It can be any partner who has not wrongfully dissociated, or, if needed, the legal representative of the last surviving partner. Or sometimes a court appoints someone. Their job during winding up is to marshal the assets, liquidate them, pay off all partnership liabilities, and then settle the partners' accounts, distributing any remaining assets or collecting contributions if there's a deficit.
And the order of payment is critical here, right?
Absolutely critical, especially for the bar exam. The priority of payments during winding up is ironclad. Creditors, outside lenders, suppliers, etc., have priority over partners. All outside debts must be paid before any partners get back their capital contributions or any share of profits from the liquidation. If assets aren't enough, partners have to contribute personally to cover the shortfall owed to creditors.
Creditors first, partners last. Got it. Can the partnership still be bound by contracts during winding up?
Yes, it's bound by a partner's acts that are appropriate for winding up. Things like selling inventory, settling lawsuits, paying final bills, but not for starting brand new business ventures. And partners remain liable to each other for their share of any liabilities incurred during the winding up process itself. The shared responsibility continues right to the very end.
So dissolution isn't instant death. It's the start of a formal, orderly process winding up focused on settling debts, creditors first, and closing the books, with partners still potentially liable throughout.
That's a perfect summary.
Okay, we spent a lot of time on general partnerships under our UPA, which is foundational. But you mentioned other types designed specifically to limit that personal liability. Let's look at those, LLPs and LPs.
Right. Limited liability partnerships, LLPs, and limited partnerships, LPs. Many of the general partnership rules still apply as a base, but these entities overlay crucial differences, primarily concerning liability.
Let's start with the LLP limited liability partnership. What's its main selling point?
The name gives it away. Limited liability. The core feature is that a partner in an LLP is not personally liable for the general obligations of the LLP, whether those arise from contracts, debts, or, crucially, the negligence or misconduct of other partners or employees.
So you're shielded from your partner's mistakes.
Exactly. That's the big draw. However, and this is vital, an LLP partner is still personally liable for their own negligence or misconduct. The shield doesn't protect you from your own wrongful acts.
Okay, so it's not a total get-out-of-jail-free card. You're responsible for your own actions, but not necessarily for the firm's general debts or your partner's screw-ups. How do you become an LLP? Is it automatic?
Definitely not automatic like a general partnership can be. LLPs are creatures of statute requiring specific formation requirements. You must file a statement of qualification or similar document with the state. LLP status is effective upon filing. It's a formal act. And the partnership's name must clearly indicate it's an LLP, typically ending with LLP, RLLP for registered LLP, or similar words. This puts the public on notice about the limited liability structure.
What about converting an existing general partnership?
That usually requires a high level of partner approval, often unanimous, or whatever the partnership agreement specifies for such a fundamental change because it dramatically alters partner liability.
And what if the LLP status gets revoked? Maybe they forget to file an annual report.
If the state revokes the LLP qualification, our source says the entity reverts to being a simple general partnership. Importantly, this revocation doesn't trigger dissolution. The business continues, but the partners instantly lose their liability shield for future obligations. They're back to full personal liability. You can see why LLPs became so popular, especially for professional firms, lawyers, accountants, architects. Before LLPs, one partner's costly mistake could bankrupt all the other partners personally.
Right. It seems like it allows professionals to collaborate in larger groups without facing ruin because of someone else's error.
Precisely. It facilitated the growth of large professional service firms by mitigating that catastrophic cross-partner liability risk while still maintaining individual accountability.
Okay, so LLPs shield partners generally from debts and other partners' acts. What about the LP limited partnership? How is that different?
LPs are fundamentally different in structure. An LP is defined as a partnership formed by two or more persons that must have at least one general partner, A&D, at least one limited partner. This two-tiered structure is its defining feature.
So two distinct classes of partners right from the start, general and limited. How is an LP formed?
Like LLPs, LPs require formal formation requirements. You must file a certificate of limited partnership with the state. This certificate needs to be signed by all of the general partners, and it must contain specific information. The LP's name, its registered agent and office in the state, the name and address of each general partner, and its duration. Notice it focuses on identifying the general partner.
Why the focus on the general partners in the filing?
Because, as we'll see, the general partners are the ones who retain personal liability. The public needs to know who they are. Let's break down the roles. Limited partners. Think of them primarily as investors. They contribute capital, money, property, sometimes services, in return for a share of the profits, their key characteristic. Liability. Limited partners are generally not personally liable for the LP's debts and obligations. Their risk is typically limited to the amount of their investment. They have a liability shield similar in concept to an LLP partner or a corporate shareholder.
Generally not liable. Are there exceptions? When can a limited partner lose that shield?
Yes, two major exceptions. A limited partner can be held personally liable if 1, they are also a general partner in the same LP, wearing both hats, or 2, and this is the classic trap, they participate in the control of the business, and the third party dealing with the LP reasonably believes, based on the limited partner's conduct, that they are a general partner.
Ah, the control rule. So limited partners need to stay relatively passive. They can't act like they're running the show.
Exactly. If they cross the line into active management and control, they risk losing their limited liability shield with respect to third parties who were misled by their actions.
What other rights do limited partners have? Can they vote? See the books.
They can join at formation or later with consent. Withdrawal usually requires notice, often 6 months. Their rights typically include voting on major issues if the agreement allows it, like dissolution, merger, sale of assets, and the right to inspect business and financial records. They can also lend money to the LP and transact business with it just like an outsider.
Okay, so that's the limited partners, investors with limited liability as long as they don't exercise control. What about the general partners in an LP?
General partners are the managers, the operators. They have the same rights and powers generally as a partner in a regular general partnership. They run the business day to day. They can contribute capital, share profits, receive distributions too.
But what about their liability?
There's the flip side of their control. General partners in an LP have personal liability for the LP's obligations, just like partners in a general partnership. If the LP can't pay its debts, the general partner's personal assets are on the line.
So the LP structure gives limited liability to the investors, LPs, but keeps unlimited liability for the managers, GPs.
That's the basic trade-off. However, there's a very common structuring technique used here. Often, the entity designated as the general partner is itself an entity with limited liability, like a corporation or an LLC.
Wait, so the person who is the general partner is actually a company?
Exactly. So Corporation X is the general partner of LPY. Corporation X has personal liability for LPY's debts. But the shareholders of Corporation X are protected by the corporate veil. It creates a layer of insulation for the actual individuals running the show through the corporate general partner.
Clever. So you can have control via the GP entity, but still achieve limited liability for the individuals behind that entity.
It's a very common structure, especially in investment funds, real estate ventures, etc. General partners join at formation or with consent. They can terminate through withdrawal, assignment of interest, removal, bankruptcy, death, or entity termination.
Okay, so contrasting LLP and LP. LLP generally shields all partners from firm debts other partners acts, not own acts.
Yeah.
LP shields only the limited partners, while the general partner remain personally liable, though often use an entity shield. Both require state filings, but the LP filing focuses on identifying the liable general partners.
That's a great way to summarize the core differences.
Wow, okay. We have covered an immense amount of detail here, from the absolute basics of what a partnership is, through formation, duties, money, property, leaving, ending, and then LLPs and LPs. My head is spinning a little, but in a good way. You listening probably feel the same, but hopefully it's much clearer now. You really should have a solid grip on partnership law after this. Let's quickly crystallize the absolute key distinctions, especially the ones you'll want sharp for the bar exam, drawing from our source summary. First, formation recap. General partnership, often informal, can be implied by conduct, sharing profits control, no writing needed unless 1 year. LLP requires state filing, statement of qualification. Name must show LLP status. LP requires state filing, certificate of LP, signed by all GPs, must identify GPs. increasing formality for increasing liability protection.
Right, the formality matches the shield.
Second, liabilities recap. This is the absolute core. General partnership. Partners have joint and several personal liability for all partnership obligations. Full personal risk. LLP. Partners generally liable only for their own misconduct, shielded from general firm debts and other partners' acts. LP limited partners have limited liability, risk-only investment, unless they participate in control. General partners have full personal liability, but often use an entity as the GP.
That liability piece is usually the driving factor in choosing an entity.
And third, termination recap. General partnership. Dissolution triggered differently for at-will partner withdrawal versus term partnerships, wound up by non-wrongful partners. LLP state revocation of LLP status reverts it to a general partnership, doesn't automatically dissolve it. LP dissolution by agreement, consent, withdrawal of sole GP, court order, wound up usually by GPs.
And remember, in winding up for all types where it applies, creditors always get paid before partners.
Perfect. Formation, liability, termination. Those are the big comparison points.
And what's really, I think, helpful to remember is why these differences exist. They're not just random rules. They reflect that constant tension we talked about, balancing the desire for limited liability against the need for control and accountability. Why does an LLP shield partners from each other's acts? To encourage larger professional firms. Why does a limited partner lose their shield if they exercise control? Because liability follows control. Understanding the why makes the what so much easier to remember and apply, especially under exam pressure. So as you review, try to connect these rules back to those underlying principles and the examples we discussed. It makes the knowledge much more durable. #outro.
And that brings us to the end of this deep dive into partnership law. We went from the ground-up definition, formation, the crucial duties of loyalty and care, financial interests, property, management rights, the complexities of dissociation and dissolution, and finally, the key differences in LLPs and LPs. It was a lot, but you should now have a really solid framework. We genuinely hope this took what might have seemed like a confusing jumble of rules and turned it into clear, structured knowledge for you. That kind of understanding is incredibly valuable, whether you're prepping for the bar or just navigating the business world. You're definitely better equipped now.
Absolutely. And as a final thought to leave you with, something to chew on, RUPA provides all these detailed default rules for when partnership agreements are silent or missing. So consider this. What does the existence of all these default rules tell us about the kind of relationship, the kind of clarity partners should be striving for in a well-drafted partnership agreement? How can proactively addressing these issues in an agreement even beyond what RUPA mandates prevent the very disputes and ambiguities the default rules have to step in and resolve? Think about how foresight in an agreement can shape a better partnership from the start.
That's a great point. Food for thought as you continue studying. We hope this deep dive was helpful and maybe even sparked some interest in the nuances of how businesses structure themselves. Keep digging, keep learning. Thanks for joining us on the deep dive. We'll catch you next time.